So let's take a quick case study. And this is where things, quite frankly, get a little bit more complicated. We've got a married filing jointly couple. They are over 65 years old. So we know that this group, these two individuals are on Medicare. So we have to be sensitive to the fact that there could be IRMA surcharges. They've got $15,000 in net long-term capital gains and $45,000 in the form of a required minimum distribution. Now, if you think about it, when we looked at those uniform lifetime tables and the factors to determine what our obligation is, what are we obligated to take out of our IRAs, that in the early years, it's roughly 4%. So if this individual is obligated to, this couple is obligated to take $45,000 out of their IRA, they probably have about 1.1 million saved in an IRA, which is not uncommon. But that's our hypothetical for the math that's about to follow. All right, so what you'll notice when we do their tax map is a portion of their income is taxed at 50%. There's this big spike right here, which reflects when we move into this higher level of taxation. Now, intuitively, we don't think it's going to work like that. Intuitively, we say, all right, well, let's assume they only were obligated to take $44,000 out of their IRA, not 45, but 44. And they decided, you know what? We're going on vacation. We need an extra $1,000. Let's make it 45,000. All right. Intuitively, what we think is, all right, well, an additional $1,000 that puts us in the 12% tax bracket. It's $120 on that additional $1,000. Remember, additional dollars beyond the threshold level just exposes those new dollars to that higher tax. What actually happens is, yes, that additional $1,000 gets taxed at 12%, $120. But it causes $850 of my Social Security to become taxable because it increased my provisional income. So that gets exposed to that 12%, another $102. Furthermore, it causes $1,850 of capital gains to be taxable. Those are taxed at 15%. Remember, capital gains taxed at a different rate of taxation, but it still produces a $277.50 tax. You add that up, it's $500. So for that additional $500, I paid half of it, $500, in the form of a tax back to the federal government. Would it not have been wiser if I had money sitting in a taxable account, at least in the year I was doing this, or money sitting in a Roth account, to have taken the money from there?